Welcome. In this video, will Zbcn coin pump continue? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When the chart is carefully examined, it is clearly seen that price movements are forming within a distinct upward trend. This rising structure is characterized by both higher lows and higher highs, indicating that buyers have taken control and that the market is generally in a positive phase. Such trends are known as technical formations that increase market participants' confidence, where upward expectations dominate and buying activity is prevalent. At the current price level, it is noticeable that the price has once again touched the upward trend line drawn on the chart. This touch is more than just a casual interaction, it carries significant technical meaning. In technical analysis, trend lines serve as both support and resistance. In upward trends, lower bands or trend lines act as support when prices experience pullbacks. It is expected that a price touching this line will hold and bounce back upward. A similar situation is currently unfolding. The price has reached the trend line that serves as the lower boundary of the ascending channel and has made contact with it. From this point on, from a technical analysis perspective, it is anticipated that the price will react positively and that the upward movement will resume. These types of patterns are often referred to as a trend support bounce and can present strong buying opportunities. Upward trends also reflect investor sentiment. As long as the price remains above this trend, investors tend to maintain a more optimistic outlook. Therefore, every touch of the trend line is often seen as a potential buy signal. Wicks, shadows, or brief pullbacks during these touches are usually interpreted by the market as temporary. What truly matters is whether the price closes below this trend line. If it maintains its position above the line, it strengthens confidence in the continuation of the uptrend. Moreover, the current price area is one where similar reactions have occurred in the past, meaning the trend line has previously acted as support. In technical analysis, the number of times a level has been tested provides valuable insight into its strength. If this point has been touched multiple times in the past and the price has bounced upward each time, it indicates that this trend line is functioning as a strong support. A similar scenario may be unfolding now. On the other hand, caution should be exercised regarding a possible trend break scenario. If the price fails to show the expected upward reaction after touching this trend line and starts closing below it, it could paint a negative technical picture. This may indicate that the trend is weakening or possibly ending. However, for now, the price remains above the trend line, so the technical outlook remains positive. The reaction that follows this touch will be quite telling. If the price gains strength from here and begins to rise sharply, it will confirm not just a short-term move but also a medium-term positive outlook. In such a scenario, the next target could be the midline or the upper band of the channel. This can offer investors new buying opportunities and profitable positions. Additionally, an important aspect of trend-based analysis is whether the trend's duration and slope are being maintained. Upward trend lines that have persisted for a long time and include multiple touches are considered more reliable. In the current structure, it can be observed that this trend has been in place for a long time and has been tested and held multiple times. This further highlights the importance of the current touch. In summary, the price has now touched the support point of a strong upward trend. According to the rules of technical analysis, a bounce from this level is expected. But we can't base analysis solely on trends. Let's look at other metrics as well. Stay tuned. In the world of technical analysis, there are many chart patterns used to interpret price movements. These formations help investors and analysts forecast the market's current condition and potential future directions. One of these patterns is the cup formation, which is generally considered a bullish reversal pattern. The appearance of this formation on a chart resembles a cup or a rounded bottom. The cup formation is characterized by the price testing low levels over an extended period through sideways and slightly volatile movements, followed by a steeper and quicker upward move. The formation reflects the psychological process of market participants. Initially, the price declines to a certain level and finds lasting support there. This support level typically forms as market participants begin to see the price as a good buying opportunity. Then, the price exhibits sideways and slightly choppy behavior, indicating indecision in the market and no clear trend direction. However, within this consolidation phase, it becomes evident that buying pressure is gradually increasing, selling pressure is decreasing, and the market is stabilizing. This stage represents the bottom of the cup. Subsequently, the price movement accelerates, the slope of the channel increases, and the price begins to rise. At this point, the critical element for investors is the target price level of the formation. In cup formations, the distance between the lowest point of the dip and the starting point of the formation, the depth of the cup, plays a key role in target price calculations. This depth offers a logical metric for how far the price might rise following an upward breakout. For example, if the starting point of the cup on the chart is at the 100-unit level and the lowest point is at 80 units, then the depth of the cup is calculated as 20 units. Upon completion of the formation and a breakout, this depth is added to the breakout level to determine the price target. In this case, a rise toward the 120-unit level is expected. These types of calculations provide concrete targets for investors and help them approach market movements more consciously. For a cup formation to be successful, it is crucial that the breakout is supported by high volume. Volume is one of the most important elements in technical analysis, as it indicates the strength and sustainability of a price move. High volume during the cup's breakout suggests that market participants are confirming the move and that there are enough buyers to support the trend. Breakouts without volume often fail, with prices returning to previous levels shortly afterward. Additionally, the duration of the cup formation is another important factor in analysis. Typically, this formation is more meaningful on medium to long-term charts, such as hourly, daily, or weekly timeframes. On shorter-term charts, cup formations can form much more quickly and contain more noise. Cup patterns that develop over the medium to long term, on the other hand, indicate more stable and meaningful market behavior. Technical analysts wait for the price to clearly break the upper resistance line of the formation to confirm completion. This resistance line is a horizontal or slightly inclined line where the price rises back to the starting point of the cup. If the price breaks this line, the formation is considered complete, and the upward move gains momentum. However, if the price fails to break this resistance line, the formation is deemed unsuccessful, and prices may fall back to the lower levels. One of the significant advantages of the cup formation in technical analysis is that it is more distinct and easier to identify compared to many other formations. Even for novice investors, the visual representation of this formation on a chart is quite clear and understandable. Additionally, the smooth and rounded movement of the price while testing bottom levels signals that market participants are buying in a patient and balanced manner. The MACD indicator, one of the most commonly used and powerful momentum indicators in technical analysis, provides critical insights into the momentum and directional shifts of price movements. The core logic of the MACD is to measure momentum by calculating the differences between short-term and long-term moving averages. This helps identify when buying or selling pressure in the market is increasing, decreasing, or staying balanced. The MACD indicator consists of two main lines. One of them is the MACD line. In technical analysis, significant signals are derived from the crossovers of these two lines, especially when directional changes occur. The key scenario to focus on here is when the MACD line crosses above the signal line, often followed by a potential upward movement in price. An upward crossover is a sign of a positive shift in market momentum. In this case, the strength of short-term price movements increases relative to long-term averages, indicating that the market may be preparing to enter a bullish phase. When the MACD line crosses the signal line from below, rather than from above, it is interpreted as a buy signal in technical terms and is considered a trigger alert for investors to open positions. The moment this crossover occurs is often a precursor to significant movements on the price chart. Since MACD indicates not only the direction of prices but also their momentum, upward crossovers signal increasing buying pressure and a strengthening bull market. We should wait for the MACD crossover. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.